Hi, I am Apurva Sheth and I welcome you to this latest edition of Fast Profits Daily. Now, today I want to talk about a common mistake that investors are making these days. A lot of investors are fearful. They are fearful of missing out on market rallies. So, what is happening right now? Markets have fallen drastically, and markets the world over have fallen sharply. Our benchmark index Nifty and Sensex have fallen almost 40% from their all-time highs. So we have entered into a bear market territory. Now what happens when we are in a bear market? When we are in a bear market, markets bounce back sharply on the upside as well. So this is just like throwing a ball from a top of a 40-story building. Now the ball falls down sharply, but it also bounces back with equal force. This is exactly what happens in a bear market. The index or stocks drop swiftly and they even bounce back, but that does not mean that they will recover almost whatever they had fallen. Chances are that after the first bounce, the index or stocks will again continue their downtrend soon. Now, this particular phenomenon is called as a dead cat bounce or suckers rally. Some people even call them a bull trap. So these bounce backs are trap for the bulls, and that's why they get this name. So let's see what has happened in the market so far. Now, as you can see out here, the index was trading around levels of 12,400 in January. It dropped lower almost 40% and hit a low of 7,500. Now, from the bottom of 7,500, the index has bounced back to levels of about 9,000. Now, this is a rally of 20%. Now, 20% rally in just 3 sessions is absolutely phenomenal. I don't think so that we have seen such kind of rallies in the past. But that does not mean that the index could head higher immediately. As you can see out here, immediately after this bounce back, the index gave up almost 50% of this gain, and it is currently trading around 8253. So this is a classic example of a dead cat bounce or a bull trap, wherein the index dropped swiftly lower and after reaching an extreme level it bounced back. But this bounce back was hardly tradable since most of the people would not have been able to enter and exit, enter at the bottom and exit at the top. That's why it's called as a bull trap. And we can see similar instances in the past as well. So if I scroll back to 2008, you will see that markets had dropped lower, but they had also recovered again. And in fact, they had recovered almost 50%. As you can see out here, the first fall in Jan 2008, markets had bounced back almost 50% of the previous fall, but the downtrend continued. And the same thing happened in the month of March as well, and later again in the month of July, where the markets bounce back. Now these bounce back rallies are swift and very sharp, so one should be careful and one should expect such kind of rallies going forward as well. Since the markets have fallen so sharply and the magnitude of the fall is also so big, one can expect the dead cat bounces or suckers rally, if you may call. So what are the things that one should look at to avoid such dead cat bounces? So I want to tell you 3 things that one can look out for. These are not the only 3 things. There are many other things that one can look at, but I believe that these are the 3 main things or the 3 most important things that one could look at. So first amongst them is the India VIX or volatility indicator. So the volatility indicator or the fear index is currently trading at its lifetime highs, near its lifetime highs. It has cooled off in the last few days. However, it still remains at an elevated level. And until this volatility index cools off substantially from current levels, so right now it's trading around 60, and I feel once it starts trading below the level of 40, that would be one of the indicator that the volatility is easing off and it would be safe to take trades on either direction. So India VIX is one indicator. Another thing that one can look at is a consistent index forming consistent higher highs and higher lows. Now what are these higher highs and higher lows? So what are these higher highs and higher lows? Now let me show you an illustration. So the index should form a series of rising peaks and rising bottoms. So here, as you can see, I've just drawn a illustration showing that. So if I can call this as a low, then this is a high, and then the subsequent low was higher than the previous low. That's why here it's forming a higher low. Then again the markets rise, and here again it has formed a higher high which was above the previous high. So this is a sequence of markets forming a higher high and higher low. Now I know that this can be slightly complicated if you are new to charts, but once you get a hang of it, this will be very simple. And for those who haven't yet seen charts at all, there is one very simple indicator which one can use, that is moving average. So one could use a short-term moving average on the index or stocks like the 50-day moving average or the 100-day moving average. If you want to identify trends from a long-term perspective, then 200 DMA or 200-day moving average is also useful. So once the index starts consistently trading above the any of these moving averages, one could say that the bear market is over and the index could probably be heading higher. Like all the other indicators and tools, none of these indicators offer foolproof system or technique to identify bottoms. So this should be used in conjunction with each other and with multiple other indicators. If you could do that, then you could avoid dead cat bounces or bull traps. So that's all from me for today. I hope you enjoyed watching this video, and in case you did, then please do like it, share it with your friends and family, and subscribe to our YouTube channel. Also don't miss signing up to our Telegram channel. It's absolutely free, and both I and Vijay post interesting stuff regularly about the markets, so you could enhance your learning and stay up to date with the markets. So that's all from me for today. Thanks a lot and have a nice day. Also, don't forget to sign up to our free newsletter, the Fast Profits Daily. If you sign up to this newsletter right now, then you would get access to this free guide, how to trade the markets like a pro. So don't miss this chance and sign up right now.